Alexei. So in retrospect, I realized Alexei will talk about finance and economics. So we had Andrei talked about polarization in the society through news. Sharon talked about trade deficits and unemployment and stuff. And Alexei will tell us about the bubble that's coming, right?
Yes. Or the bubble that already came 5 times before. Okay, so first of all, I just wanted to say that this was amazing work before me, Sharon. So my classmate, when I did a PhD, actually based his dissertation on Sharon's papers from years ago. So this work is already kind of proliferated in new generations. In contrast, I'm just going to give you a couple of interesting facts and a simple interpretation of those facts. I'm going to be talking about what's called the global financial cycle and financial flows. So specifically in this talk, I'm going to focus on how the global financial cycle and global financial crisis affect different countries in different ways. So why is there heterogeneity between countries? So what is a global financial cycle? I'll start with observing that asset prices strongly co-move across countries. Statistically, there's a very strong global component in asset prices, which means there's a time series that explains a lot of variation in every single time series of asset prices for every country. You can extract those global components just statistically from panel data, and two strongest global components are going to capture close to half of the total variation in asset prices, which is telling you that asset prices are really tightly connected across countries. The same thing actually applies to financial flows. If you look at the panel data for financial flows in and out of countries, there are two equally strong global components in that panel. They also capture close to half of the variation on average between countries in time series. Moreover, these two global components are very strongly related to the global components in asset prices. So it's the same thing that's going on in the background that's driving both asset prices and financial flows. This is just, at this point, just statistically extracted time series. And we can try to think about what they really show us, where they come from. The second observation is that those statistically extracted time series strongly correlate with financial variables, with variables that show us the risk-taking capacity of global banks and other intermediaries, and variables that more broadly show us how financial markets are pricing risk. That's why this co-movement is called the global financial cycle. The way to envision this is that once in every few years, there's a downturn in global investment. Foreign investors are leaving pretty much all of the countries, and asset prices are going down across the board. And then it goes back again, and then in a few years, it happens again. Okay, I'm going to show you this in the picture. This is a pretty recent timeline, the last 25 years. This picture has two time series. One of them, the solid line, is the averaged capital gains, which means growth in asset prices, all converted to dollars, averaged across a wide panel of countries. So you can see what happens here. You can clearly see the global financial crisis of 2008. The average asset price in the world dropped by 20%. This is slightly deseasoned, right? So the actual numbers are slightly different to account for seasonal variation, but it's very close to raw data. Other events you can see in this picture are, for example, this European debt crisis, which was a global event, this Chinese stock market crash, which was also a global event, turns out, and then this time of trade war uncertainty. This is 2018 when first tariffs were put into place, so financial markets priced a lot of risk in those assets. And then you can see something also happened in 2022 here. The second line, the dashed line in this graph, is net purchases of foreign assets by investors in all countries on average. So you might wonder why this thing does not average to zero, because if you purchase foreign if you purchase foreign assets as an investor, the world collectively cannot purchase anything other than zero because we don't trade assets with the moon, for example. The answer is that this is gross purchases, even though they're called net purchases. So this is just investors from France buying foreign assets investors from Germany buying foreign assets, investors from the US buying foreign assets, they can simultaneously buy positive amounts because this does not include purchases of French assets by foreign investors, purchases of German assets by foreign investors, and so on. So this is just one side of the market. Yes, it's sales. So French, German, American investors are collectively, on average, selling foreign assets and coming back home. And you can see they move in lockstep, and the magnitude is really strikingly close as well. You can again see the global financial crisis and all other events. All right, so this is just showing you some recent history. This global financial cycle is really a few years frequency type of event. Okay, now the next thing to talk about is exactly this distinction between gross and net flows. So net flows must sum to zero because the world is a closed system. Gross flows don't have to be summing to zero. And in the remainder of the talk, I'm going to show you something about gross flows exactly. So let's focus on them. What we call gross outflows is exactly those purchases of foreign assets by domestic investors. And then what we call gross inflows is, ironically, net purchases of domestic assets by foreign agents. So this can be positive and negative, right? Even though it's called gross. All right. So one thing to note about gross flows is that they're actually much larger than net flows. Why? Because they co-move again. So when foreign investors are buying something in France, simultaneously French investors also invest abroad a lot. So on net, the number is going to be much smaller than those two gross numbers. As a result, in the data, gross flows are actually 2 to 4, sometimes 7 or 8 times larger than net flows, and they're much more volatile. So if you just look at net flows, let's say net capital outflows from the US, this number is going to be masking two things that are going on simultaneously and are potentially important to look at separately. Okay, so this is kind of not new. People have noticed this after the global financial crisis when a lot of countries did not show any large net outflows, yet their financial markets were disrupted because they actually showed a lot of gross outflows. It's just that their domestic investors simultaneously came back and brought their assets back. So it's important to separate the two. Now, my question here is, how different is this across countries? So for example, if you look at this picture from before this global financial crisis or this event, how different was countries' reaction? So who was affected more? Was it France? Was it Germany? Was it India or the US? Well, we can try to measure this. Before measuring this, I'm going to show you global components and the gross outflows and gross inflows. You can see they co-move very tightly, right? There's not really much space for the difference between them to co-move. Okay, this is again the statistically extracted principal components from those panels. Okay, so but now I'm after the heterogeneity. I want to see who's affected more. So to do this, I can just project countries' individual time series, so countries indexed by I here, on this global time series. And then, for example, take the time series for asset acquisition. This is net purchases of foreign assets by our investors. If a country I has a high projection coefficient beta, this means that when everyone on average is purchasing foreign assets, this country is purchasing more than average, right? And then conversely, if everyone is selling foreign assets, this country is selling more if its beta is high. This is just a projection, right? This is pure statistics. We can also look at how they incur their liabilities. So what happens to their liabilities to the rest of the world? And we can measure the same projection. If a beta of country I is high here, this means that when everyone is losing foreign investors, this country loses more foreign investors than average. Or in good times, when foreign investors invest, countries with a high beta gets more foreign investors. And then, so once I get those betas for all countries, I can just try to make sense of, the differences between countries. I can see what variables this beta is correlated with. So it turns out if we start with asset acquisition, liability incurrence, advanced economies look like they're more exposed to this cycle. So it looks like when times are bad, when there's a global crisis and foreign investors are leaving from everywhere, there's capital flight, advanced economies are affected more because foreign investors are selling more of their stuff. If you compare France and India, for example, it looks like investors are really flying from France and not so much from India. All of this is normalized to the stock of assets like one quarter before. So this just says that if a country is an advanced economy, then when there's let's say 10% capital flight everywhere, this advanced economy is losing 2 percentage points more of its foreign investor base than India. This is very strongly correlated with how much foreign assets a country has as a share of GDP. The one good measure that tells you if a country is an advanced economy or emerging market is if it has accumulated a lot of foreign assets relative to its size, right? And again, countries with large stocks of foreign assets that have developed financial markets are losing more foreign investors in bad times. This is kind of unexpected, and this hasn't been studied. This wasn't known before, really. Okay, let's look at the other side of this. So the other side is acquisition of foreign assets. How much our investors are actually selling when everyone is selling foreign assets and come back. And again, this is much stronger in advanced economies. When everybody is selling in the world, when there's a global financial crisis, investors in advanced economies sell much more and come back much more actively. So we call this phenomenon retrenchment. This is when investors really repatriate their assets and put them into domestic asset markets. Now, this might sound a bit surprising, right? We are used to thinking that financial crises affect emerging markets much more. And this is indeed very true if you look at asset prices. So asset prices in emerging markets underperform advanced economies in bad times by a very wide margin. So how do we square those two facts? The answer is, let's try to interpret this retrenchment as domestic investors really saving their asset markets in bad times. So when times are bad and foreign investors are leaving, what if advanced economies just have a lot more foreign assets and they can use them to replace foreign investors? And this goes smoothly in advanced economies. And then in emerging markets, because there's not so much investment abroad stashed for this purpose, in bad times, it just doesn't happen. Nobody saves domestic asset markets and prices have to fall. So this is something I recently did in my work. I interpreted these facts in a model. The model is really the minimal framework you need to capture both of this simultaneously. So what happens in this model is there's one main ingredient that separates it from traditional models of international finance. This ingredient is segmented markets. There's a large but relatively recent body of work studying segmented markets. What market segmentation means in this environment is that not all investors have access to all assets in the world. The traditional view would hold that French investors can just, without any friction, buy assets in all countries, and they can hold a very diversified portfolio. So here, this doesn't happen because the data suggests that French market is very special for French investors. So in bad times, this is really where they look at. And then they are willing to come back if the French market offers them high enough returns. And they're not willing to go to Germany, for example, unless returns are much higher in Germany. So what this means is really for the model that in order to arrive at segmented markets, you just need to give French investors access to French assets and then some maybe globally intermediated asset pool with global intermediaries at the center of the model. And then once you have the structure, it's kind of easy to launch global financial cycle by just shocking the risk-taking capacity of the intermediaries to generate episodes of capital flight. One more thing that I wanted to tell you before telling you results and showing you some more pictures is that we can just come back to the data and see if this pattern that we noticed is robust. It is robust if you consider a few different extensions. One extension that you might wonder about is, okay, so I talked about the global financial cycle. I defined it as a global component in capital flows. There are other definitions, right? You might think that global component shows you something orthogonal to the global financial cycle. So let's define it through financial variables directly. For example, the price of risk in financial markets. and the pattern remains robust. When the price of risk is high, this means financial markets are in distress. And it is in those times that advanced economies are losing a lot of foreign investors, much more than emerging markets in terms of quantities. Okay. What does the model give you in this setup? Well, one thing that the model gives you is that in the model, you can just price risk, price country-specific risk across countries, get expressions for price of risk as a function of, for example, the size of the local financial market, the local GDP, and the foreign assets of local investors. How much they have abroad stashed for the bad day, for the rainy day. Turns out that in rich countries, they have a lot of foreign investment. Risk premia on assets in their domestic markets are low. That's because they have a lot of wealth to support their domestic markets in bad times. So whenever foreign investors are trying to leave their market, domestic investors have no problem reallocating even a small portion of their wealth that will actually be a big deal for the domestic asset market and support asset prices. And it's also making their risk premia and asset prices much less sensitive to global shocks by the same token. So turns out that when there's a capital flight episode in the model, foreign investors are trying to leave the country, and then domestic investors are trying to replace them. If they have a lot of firepower, a lot of ammo to replace those foreign investors, then this foreign demand shock for assets translates into a quantity adjustment in the market. So quantities move a lot. There's a lot of inflows, a lot of outflows. They compensate each other, and prices are stable. We call those markets elastic, which means prices are which means quantities move a lot for a given move in price. And then in poor countries, local investors just don't have that much. So they cannot replace domestic investors, and adjustment happens through prices. So those markets are much less elastic. And this is a function of countries' wealth. The model is super simple. There's only one mechanism in this model. So it allows you to talk to this one specific force. Turns out that in this model, this force explains close to half of the relative performance of advanced economies compared to emerging markets that we see in the data, which means there's a given amount of variation in asset prices between advanced economies and emerging markets, and we explain half of that. Here's some pictures. So in the data, the time series that I showed you before, you can scatter them. You can scatter this time series for prices. The model is able to almost perfectly fit what happens in the data with asset price movements and capital flow movements, and the model can capture maybe half of the slope of the variation in relative prices. Okay, I'm not going to conclude and even repeat what I just said. Thanks, everyone. Thanks for this amazing session. I can take maybe one question.
Yeah, go ahead and take one question.
Thank you. I misunderstood a little bit. In your model, you showed just determination 3%, but in the end, you talked about 50%. And what does it mean? The coefficients cover just R square is 3%, and then are you talking about different things? What is the meaning of those charts, the previous ones, the tables when 3% is shown?
Yes.
Versus those. What are they talking about?
Yes, great. Thank you. So the regression results that I showed you before show you that when there's a one standard deviation shock to global capital outflows, advanced economies are selling 3 percentage points more of their foreign assets than emerging markets. So you could think advanced economies on average sell 10% of their stock. Emerging markets will sell 7% of their stock. This is really the difference here. That is 3%. Now, what I'm talking about in this graph, the half of the variation, is that if you consider two episodes with capital flows, for example, being 0 on net in this period and being 10%, so everybody is buying 10% of what they had one quarter before, in the data, the prices are going to move by, let's say, Right.
What was not clear, R squared 3% in your table, which you showed.
Oh, the R squared 3% in my table is when I take the loadings, the betas that I estimate for, let's say, this global factor, and then I regress those betas on countries' characteristics. So the betas are different across countries. 3% of the variation in the betas is explained just by this one variable, the indicator variable that tells you if a country is advanced economy or emerging market. This R square is super low, yes, because of the noise, yes, but the coefficient is still precisely estimated. This is what's important here. I would not expect R squared to go up to 1 just because there's a lot of other channels in the data. And what I'm after here is really singling out this one mechanism, because we need to understand this one mechanism before we go to more complicated models, because it's always going to be there among other mechanisms. So this is just like maybe a first step in understanding the, in understanding what the big model would be that would give you R square 1. Thank you.